Hello, in this video we will talk about patterns and how the patterns work. In the previous videos, we have done 4 videos. So in those videos we have learned, in the first video we learned uptrend, downtrend and sideways market. In the second video, we learned that the market spends most of the time in the sideways market and the less time in the trends, lower or up. This was we learned in the second video. In the third video, we learned support and resistance. So after a move, the first point of turning is the resistance, and the point of turning from the retracement becomes the support. So as long as the market remains between these two lines, it is said to be in the sideways market. In the fourth video, we learned why support becomes resistance and resistance becomes support. So in this video, we will talk about patterns. I use 5 patterns in my trading. So let's learn about those patterns. So the first pattern is a symmetrical triangle. So what we have is a trend, and then the market reverses. So now this at this point, I think everyone can let's say the market turns up. So at this point, I hope that everyone can identify support and resistance in this normal market behavior. So we'll have our resistance at the top and our support at the bottom. This is our initial trend, which is an uptrend. And then what we have, this is symmetrical triangle. So symmetrical means that it looks same from the both sides. So what happens here is that the market will uh, turn turn before the resistance, and the market will turn before the support. So it will keep on doing like this. Now this becomes the new resistance, and then this becomes the new support, and the market gets even smaller. So in this pattern, we see volatility getting less, and finally, when the volatility is very less and the market has nowhere to go, we finally have a breakout, which is mostly no pattern is 100% accurate. So you must know that. So 70 to 80% of the time in a symmetrical triangle, the breakout will be in the direction of the trend, which was in this case an uptrend. So this is our symmetrical triangle. Same works for the downtrend, that if we have a downtrend and the market turns and then turns from here, so this becomes our support and this becomes our resistance. Now the market will keep on squeezing, and then finally we have a breakout, which is mostly in the direction of the previous trend. So this is our symmetrical triangle. Then we have ascending triangle, which is somewhat similar to this, that we will have an uptrend, the market turns, this becomes resistance, the market turns, this becomes support. This is our initial trend, but this time the market is showing more strength, and it goes back to the resistance, and then when coming down, it goes up again, and after coming up again to the resistance, it is getting even smaller, and then finally we have a breakout. So this pattern is even more bullish, as we have more pressure from the buying side. In the symmetrical triangle, we can say that there is pressure from the top as well, from the resistance as well. That is why the price is not even able to come to the resistance, but there is buying pressure as well. So the market is trading in between and then giving a breakout. But in the ascending triangle, we see that the market comes back to the resistance, and but not to the support, which shows that the buying is stronger from the lower levels, and then finally we have a breakout. If we reverse this, then this becomes support, and this becomes resistance, and the market comes back to the support, goes up, turns way before the resistance, and then turns again, and finally we have a breakdown, which is we have a breakout which is in the trend of a previous trend. This is our symmetrical triangle. Then we have our rectangle pattern. Rectangle pattern is basically trading support and resistance. But the thing is that all the patterns are using support and resistance. The patterns are made so that it is easy for the beginners to understand. But in the general sense, they are just trading support and resistance. So in the rectangle pattern, we have uptrend or a downtrend. Then we have a turn, This becomes our resistance, this becomes our support, this becomes our support, this becomes our resistance. And then the market comes perfectly to these levels, and then finally we get a breakout. So this is a rectangle, and this is a rectangle. So this is very simple, that we have a sideways market between the support and resistance, which usually continues for a long time, as we have seen that the market will spend most of the time, 70 to 80% of the time, in the sideways market. And then finally, when the market is ready, it will give a breakout from the resistance area, and we get a trend continuation. Same works for the downtrend. So 3 patterns we discussed: the symmetrical triangle, the ascending triangle, and the rectangle. So these are the 3 patterns we have discussed. Now we have our bull flag. A bull flag is an uptrend. The market turns from the resistance, and then we have an up move, which is less than there is selling pressure from the top, and it also crosses the bottom level. It also crosses the support. So it keeps on doing this for some time, and then finally we get a breakout to the top side when all the selling is absorbed. Now how to differentiate this from the downtrend, because this is basically a downtrend in an uptrend. This is our main trend, and then we have a small downtrend in an uptrend. How we know this is a downtrend? Because it is making lower lows and lower highs. So this is basically a downtrend in an uptrend. But how to differentiate this from an actual downtrend? That these swings will be smaller, and they will not go below the initial trend. Let's say the market is behaving something like this, and this we had an ascending triangle. I mean, this is a symmetrical triangle, but now we are making swings like this. So this becomes our bullish flag, and then we get a breakout here. So if the market actually wants to fall, it will not fall like this, as we have discussed. When the market wants to move, it moves very fast. It will not make these slow swings. If you remember, I gave the example that if the market wants to go to point A to point B, it will not go like this. It will go sideways, and in the last day it will directly jump there. So if the market really wants to come down, it will not come down like this. So this shows that there is some profit booking going on, while there is some pressure from the buying side as well, as the market is not able to fall fast. So after the breakout from the upper level, we get a trend continuation. So this is our bullish flag, and then we have the bearish flag. Then finally we have a cup and handle pattern. This pattern most of the people do wrong, because they draw the cup and handle pattern even if the previous trend was down. This is wrong. The cup and handle pattern is only valid when there is a previous uptrend. It does not work with previous downtrend or sideways market. This is a continuation pattern that we had an uptrend, then finally we hit a resistance, and we had selling, but the selling was very weak, and the market is not able to even make swings, as in the if we compare cup and handle to the bullish flag, then at least in the bullish flag the market was able to make swings, but in the cup and handle pattern the selling is very weak, so the market is not even able to make swings. So we have a rounding bottom type pattern. Then finally we hit the resistance again, so there is some selling, but the selling is weak because there has been a lot of accumulation in this phase, so the buyers are strong, so the market turns, making a smaller handle, which we call the handle, a smaller retracement this time, and this time it finally breaks the resistance. This is a very highly successful pattern because the rounding bottom represents a lot of accumulation. As we have seen that if the market really wanted to retrace, it will come down fast, but if it is moving this much slow, then this means that there is buying happening, and we can even confirm this by the volume, as the volume while the cup is forming will be low. So then we have a cup and a handle, and then we have a breakout. The reverse of this will be the reverse cup and handle, that we had a downtrend, and then we have a reverse cup. This becomes our support. This is our support. So this is the downtrend. Then the buyers are very weak, so they are not able to make good swings like this to take the market high. Instead, there is a lot of selling pressure, and the market is moving sideways, and then finally market turns as well, and then we have a breakdown. So this area represents as people are accumulating more sell positions. We can see that the volume will be low, there will be very less volatility, and the market continues. So these are the 5 patterns that we learned. They are symmetrical triangle. This is ascending triangle. Then we have a rectangle pattern. Then we have bullish flag. And finally we have a cup and a handle pattern. So I hope these 5 patterns are clear. The psychology is also clear, that if the market wants to go down, why these are continuation patterns, because they show that neither the sellers are not strong, or in the downtrend the buyers are not strong, because if the market makers actually wanted to take the market lower, they will not do this in a slow way, they will do in a fast way. If the market wants to go down, it goes down fast. So this is Nifty right next to us, the market is live. So if we see in the morning phase on the 8th, not today, yesterday, we had this small asymmetrical triangle forming. As you can see, the volatility is getting less, and then finally we had this breakdown, and the move was very fast. As you can see, the market moved really fast. So when the market really decides to go somewhere, it does it very fast. And then we had this rounding bottom forming, and this is our rounding bottom, and I gave call to buy in the morning at 9:51 at this point, that it is a buy because the market is getting the market is not making any big swings and the bottom is rounding. So after the break of this level, I thought the market could go higher, and it did, and we achieved the target as well. If you can see that I mentioned to buy at 951, the market was at this candle, and then we had a good 50 to 60 points rally. So almost 70 to 80 point rally actually. So in this we had a rounding bottom. So I hope the patterns are clear. The 5 patterns: the symmetrical triangle, the ascending triangle in which the market is moving to the resistance side. Then we have a rectangle pattern, a bullish flag, and a cup and a handle. So the patterns, these are the patterns which are accurate. I do not trade double bottom or triple bottom and all, because these are not breakout trades. I want to trade breakouts, so this is not my trading style. I use these 5 patterns which I have found to be successful. So this is the 5th video. In the 6th video we will talk about volume, and in the final video in this series we will talk about volume profile, and then afterwards we will directly move on to trading strategies. So I hope you learned something from this video, and we'll continue to make videos, and as I have said that in the 6th video we will talk about volume. Okay, so thank you for watching. Hope you have a wonderful day.